When the economy stumbles, not all housing markets fall equally. Some don't just stumble, they collapse, fast and hard. In 2025, with interest rates hovering at record highs and inflation squeezing every household, certain cities across America are proving to be ticking time bombs of overpricing, rampant speculation, and fragile local economies. The promise of endless growth has vanished, replaced by the grim reality of a market on the brink. We're not talking about a small correction. We're talking about a complete unraveling in markets where home prices surged by a jaw-dropping 50 to 70% in a few short years. These are the places where a typical buyer is forced to spend more than half of their monthly income just to cover a mortgage, not to mention the thousands more added by soaring insurance premiums. If a recession hits, these markets could see values plunge 40 to 60%, wiping out hundreds of thousands in equity almost overnight. From once flashy boomtowns to overbuilt suburbs, here are the 10 U.S. housing markets most likely to crumble first when the economy goes down. For more crucial analysis like this, consider hitting that subscribe button.
Number 10. Phoenix, Arizona. Phoenix has been riding a housing rocket since 2020, but the same fuel that sent it soaring could turn into a firestorm if the economy tanks. The median sale price here is now $445,000, a significant drop of over 9% since March. And with an average of 44 days on the market, sellers are facing a tough new reality. The local economy is tied to sectors sensitive to downturns like tourism and construction, which together employ a massive portion of the workforce. Despite recent wage growth, a typical buyer is stretched razor thin, spending over 40% of their monthly income on a mortgage alone. This financial strain is already showing in the numbers. While the national delinquency rate remains below historical averages for now, mortgage delinquencies on conventional loans have increased, and in foreclosure-heavy states, this is a key red flag. Investor activity has been intense, and now, as supply climbs, with active listings up 25% year over year, the market is teetering on a dangerous edge. Condos and townhomes in particular are struggling, with their listing success rate dropping to its lowest point since 2011. Builders are now offering huge incentives, including mortgage rate buydowns into the 3 to 4% range, a clear red flag for a market desperately trying to move a glut of new inventory. A price drop of 20 to 30% wouldn't be surprising here, which would wipe $89,000 to $133,500 off a median-priced home.
Number 9. Austin, Texas. Austin was the poster child of the pandemic housing boom, and now it's primed to be a cautionary tale. The median sold price has dropped to $455,000, a significant 17% below its peak. This is more than a dip, it's a structural correction. Affordability is in free fall as the local market is heavily tied to the volatile tech industry, which has been hit by a wave of ongoing layoffs from major employers. These job cuts are weakening buyer demand and cutting into household incomes. But the pain isn't just in residential real estate. Austin's commercial office vacancy rate has surged to nearly 28%, the highest in the nation. This oversupply in the commercial sector is a leading indicator of residential weakness, as a city with empty offices will soon have an exodus of residents. Inventory is swelling fast, up nearly 40% year over year, and nearly 60% of all listings have had at least one price drop. Builders who went all in during the boom are now delivering thousands of new homes into a market where demand is fading, creating a dangerous oversupply. Austin's combination of high prices, an inflated supply, and industry-specific job risk could easily produce price drops of 25 to 35%, erasing over $140,000 from median home values and leaving recent buyers deeply underwater. For more vital information like this, be sure to subscribe.
Number 8. Las Vegas, Nevada. Las Vegas is no stranger to housing market meltdowns. In 2008, it became ground zero for the U.S. crash, with prices plunging over 60%. Today, the city's setup looks dangerously similar, built on a shaky foundation of tourism and speculation. Median home prices climbed more than 50% since 2020, but the market is now facing a dramatic and sustained cooling. The median sale price is now $440,000, which, according to Redfin, is down 2.2% year over year. But that headline number hides a deeper, more troubling reality. Homes are sitting on the market for an average of 56 days, compared to just 35 days last year. This stall is causing sellers to panic, with over 33% of listings seeing at least one price drop. The local economy is heavily tied to tourism and hospitality, making it uniquely vulnerable to a recession. When the economy slows, visitor spending is the first to go, and layoffs ripple through hotels and casinos, which translates to a rapid spike in foreclosures. Nevada is leading the nation in foreclosure filings, with notices of default filed on 1 in every 2,326 housing units in July 2025. This is up 12.4% from June, putting Las Vegas among the top metros for foreclosure activity nationwide. Investor activity has also been intense, with corporate buyers and Wall Street hedge funds snapping up properties, and now they are the first to dump them as profits dry up. Active listings are up more than 30% year over year, and new construction has been running at full tilt, especially in the suburbs of Henderson and North Las Vegas, creating a dangerous oversupply situation. If the economy contracts, Las Vegas could easily see price declines of 20 to 35%, wiping $88,000 to $154,000 off a median-priced home. It's a painful repeat of the city's housing history.
Number 7. Boise, Idaho. Boise went from a quiet, affordable city to one of America's hottest markets almost overnight during the pandemic, but the rapid out-of-state migration that fueled the boom has slowed dramatically. While some national reports show a slight price increase of around 2.0% year over year to a median of $515,000, Redfin data reveals a deeper trend. An astonishing 45.1% of all listings in Boise have had a price drop this year, a clear sign of a market where seller expectations are no longer meeting buyer demand. Active listings are up a staggering 45% year over year, and new construction is still underway from the building frenzy of 2021 to 2022. A flood of supply is now meeting a fading demand. The market is telling a tale of two realities. Existing homes are selling quickly in about 17 days, but new construction homes are sitting for much longer as buyers become more selective. This signals a coming glut of inventory that will inevitably put downward pressure on all prices. Zillow forecasts a modest decline of around 2.2% over the next year, but with a massive backlog of new homes and rising rates, a more brutal correction is a very real possibility. The local job market, which relies heavily on construction and manufacturing, can't sustain these prices alone. In a downturn, the housing market could feel an immediate shock. If the economy stalls, Boise's home values could tumble 20 to 35%, knocking $103,000 to $180,000 off a median-priced property. For a city that saw one of the fastest price run-ups in the country, the reversal could be just as swift and brutal. If you find this kind of content valuable, be sure to hit the subscribe button and turn on notifications so you don't miss our next video.
Number 6. Tampa, Florida. Tampa's housing market became one of Florida's hottest during the pandemic, with median home prices surging more than 60% between 2020 and 2022. But the local median household income of $72,000 means a typical monthly mortgage payment on a median home is now swallowing nearly 47% of the average household's gross income. One of Tampa's biggest threats isn't just high prices, it's the crippling insurance crisis. Home insurance premiums in the region have exploded by 40 to 60% in just 2 years, with many homeowners paying $5,000 to $7,000 annually. Redfin data for July 2025 reveals that the median sale price is now $437,000, down 4.6% year over year, and nearly 39% of all listings have had a price drop. The market's rapid rise was fueled by a mix of out-of-state migrants and investors, groups that retreat fast in a downturn. Inventories climbing up more than 35% year over year, and homes are staying on the market for an average of 45 days, far longer than during the 2021 bidding war frenzy. If the economy sours, Tampa's housing values could slide 25 to 35%, wiping $109,000 to $153,000 from median prices. For recent buyers stretched to their financial limits, that's a fast path to negative equity. While the insurance market is showing signs of stabilization, premiums still remain a massive burden, making a home that once looked affordable now an unbearable financial strain. For more exclusive content that helps you discover the nation, be sure to subscribe.
Number 5. Denver, Colorado. Denver's housing market has been riding high for years, but its price-to-income ratio has reached dangerous territory, creating a full-blown affordability crisis. Between 2015 and 2022, median home prices surged nearly 80%, and even though the market has cooled, the median sale price still sits at $570,000. The affordability gap here is now critical. The average hourly wage has increased by 37% over the past decade, but the number of hours required to cover a monthly mortgage payment has shot up by a shocking 94%, from 50 to 97 hours per month for the average homeowner. This imbalance has already started to show cracks. Active listings are up nearly 30% year over year, and the average days on market has doubled from its pandemic lows to 35 days. Redfin reports that a staggering 46.1% of listings have experienced a price drop this quarter, a clear signal that sellers are losing their pricing power. Much of the city's boom was fueled by tech, finance, and real estate jobs, sectors that tend to feel the sting first in a downturn. Adding to the risk, Denver's rapid construction pace during the boom years is now a major liability. A report from the Common Sense Institute highlights a persistent permitting gap, meaning that even with a recent decline in new construction, the city has a massive overhang of new inventory that would collide head-on with shrinking buyer demand in a recession, creating a dangerous oversupply. For a city that's long been viewed as a safe bet for housing, the correction could be a harsh wake-up call, with price drops of 20 to 30%, shaving $114,000 to $171,000 off median values.
Number 4. Salt Lake City, Utah. Salt Lake City's housing market has been on a breakneck climb, but it's now showing significant warning signs of a full-blown correction. The average home value is $565,000 according to Zillow, up only a meager 1% over the past year, a dramatic cooling from the 23.8% growth seen in 2021. This boom was fueled by a massive flood of out-of-state buyers, a pipeline that dries up fast in a recession. The local economy, while still resilient, is heavily concentrated in sectors like tech, construction, and real estate that are vulnerable to downturns. A report from ProFocus Technology found that while the Silicon Slopes tech sector is still growing, the pace has slowed, and that cooling is a direct threat to the market. This isn't just a hunch, the data is screaming a warning. According to Redfin, active listings are up more than 40% year over year to their highest level in 8 years. The city had 1,513 homes for sale in July 2025, a stunning 37.4% increase from the previous month alone. This incoming supply from the 2021-2022 frenzy is now colliding with shrinking buyer demand, pushing sellers into steep price cuts. A report from Reventure App found that over 34% of listings have had a price reduction this year, nearly triple the rate seen during the pandemic. The market is estimated to be 24.5% overvalued, and analysts are warning that if demand remains low and interest rates stay high, prices could fall by 5 to 6% over the next 12 months alone. For a market that grew faster than almost anywhere else in America, such a reversal wouldn't just be a correction, it would be a shock that redefines the city's housing landscape and leaves many who bought at the peak deeply underwater. Make sure to subscribe so you don't miss our next video.
Number 3. Miami, Florida. Miami's housing market has been running on overdrive, but a major correction is underway. The average home value is now $580,000, down 1.7% over the past year. This imbalance is unsustainable, and if the economy falters, Miami could be one of the first luxury-driven markets to crack.
The city's housing boom has been fueled by a mix of foreign buyers and high-net-worth investors who retreat quickly in a downturn. A staggering 49% of new construction in the Miami metro area was bought by foreign investors in the last 18 months, primarily from Latin America, a fact that solidifies its standing as a premier global real estate hub. However, Miami-Dade County's property appraiser has proposed considering a reduction in property taxes for 2025, a clear sign that officials are now taking market deceleration seriously. According to Redfin, the median number of days between listing and contract dates for Miami condos has jumped from 46 to 63 days, and inventory for existing condos has swelled to a massive 14 months of supply, signaling a strong buyer's market. Insurance is a ticking time bomb, with premiums surging 50 to 70% in recent years. A recent Moody's report found that a single Category 5 hurricane hitting Miami could be worse than a typical recession, causing long-term population loss and higher insurance costs. Property taxes can easily exceed $9,000, creating annual carrying costs of over $20,000 before maintenance or HOA fees. Miami's glittering facade hides a housing market that's dangerously leveraged on wealth and speculation, and if the economy contracts, Miami could see price drops of 30 to 40%, erasing $174,000 to $232,000 from median values.
Number 2. Sacramento, California. Sacramento became a hot market for remote workers from the Bay Area, but that migration wave is now a trickle as tech layoffs rise. The median sale price is now $483,502, according to Zillow, down 2.7% over the past year. This number is the result of a significant slowdown, with the median days on the market climbing to 28 days, a 10-day increase from last year. Without that constant inflow of wealthier buyers, local demand alone can't sustain these inflated prices. Inventory is up over 46% in June from a year earlier, and builders, who added thousands of homes in surrounding suburbs during the boom, are now delivering those units into a cooling market, creating a dangerous oversupply. Redfin data for Sacramento County shows that 41.8% of homes on the market have had at least one price drop this quarter, and buyer demand is fading, with a recent report finding a score of 38 out of 100, indicating a declining market. Property taxes average about 1%, but that's still more than $5,000 annually on a $505,000 home. Combine that with rising insurance premiums from wildfire risk, a major risk to over 66% of properties in the county, according to First Street Foundation, and many homeowners are feeling the pinch. For a market that sold itself as the affordable alternative, a sharp correction could leave thousands of recent buyers with negative equity. Unemployment in the Sacramento metro area has also risen to 5.6%, higher than the national average, and key job sectors like construction, financial activities, and manufacturing are all seeing year-over-year declines, according to the Employment Development Department. The very forces that fueled Sacramento's boom, migration and affordability, are now reversing, making it one of the state's most vulnerable markets. To see more videos like this, subscribe now.
Number 1. San Francisco Bay Area, California. The Bay Area has always been one of the most expensive markets in the world, but its reliance on the volatile tech industry also makes it one of the most fragile. The median home price across the region is still a staggering $1.41 million, but prices are down in many segments. A new report from Beacon Economics found that the Bay Area's tech industry saw a net loss of 8,700 jobs in the first 2 months of 2025 alone, a huge shock to the Bay Area economy. Tech layoffs have already hit major employers, with thousands of jobs cut at companies like Meta, Google, and Salesforce, and inventory is slowly climbing, with many luxury properties hitting on the market for months, something unheard of during the pandemic frenzy. The Bay Area's reliance on volatile equity markets is its Achilles heel. According to a Zillow report, condo prices in San Francisco have dropped 14.6% from their 2022 peak, essentially erasing all gains made since 2015. When stock values fall, down payment cash dries up, especially for buyers in the $2 to $5 million range.
Carrying costs are punishing. Property taxes average around 1.1%, meaning $15,510 annually on a $1.41 million home, while insurance can easily top $4,000 to $6,000, even higher in wildfire-prone counties like Marin. Redfin data for July 2025 shows that homes are now sitting on the market for an average of 28 days, a clear sign that buyers are no longer willing to get into a bidding war. In a major downturn, prices could fall 30 to 40%, erasing $423,000 to $564,000 from a median-priced home and over $1 million on ultra-luxury properties. Such a collapse wouldn't just be an economic event, it would be a cultural shockwave, rewriting the Bay Area's housing narrative for years to come.
Final message: the unraveling of a dream. This deep dive has shown us that the housing market isn't just slowing down. In many of America's hottest cities, it's unraveling. The painful lessons from places like Phoenix, Austin, and the Bay Area are not isolated events. They are a powerful warning for us all. The illusion of endless growth has been shattered by the cold reality of inflation, rising interest rates, and an unsustainable mountain of speculation. The market has shifted, and the rules of the game have changed. It's no longer about who can bid highest, but who can see the signs of collapse before it's too late. The most prepared are those who arm themselves with knowledge and data. If you want to stay ahead of the curve and protect your financial future, subscribe to Discover the Nation. We'll continue to bring you the data and analysis that helps you navigate these uncertain times. We'll see you in the next video, because sometimes the most valuable knowledge of all is knowing where the house of cards is about to fall.